Good afternoon. Welcome to Home Savvy Central. I am Mike Patel with First Team Real Estate right here in Anaheim Hills, California. And today we're going to talk about the very important and very common topic out there on the streets, what we call on the streets of real estate. People are wondering what's happening to real estate. Is there a housing market crash coming in 2024, 2025? So I wanted to dig deep into this topic. It's a very common topic. It's a very puzzling topic. And everybody is asking the same question. Is there a housing market coming? And if it is coming, some people say it's coming. Some people say it's not coming. And if it's coming, when is it coming? And how bad is it going to be? Is it going to be like the 2008 housing crash? I'm glad you're here. This is my first live stream. I used to have another channel and I just started this brand new channel. So welcome to my channel. You're always welcome to subscribe to my channel. Of course, the name of this channel is Home Savvy Central, and I focus on homeowners and home sellers, giving them the information, the trends, the updates, and what's best for homeowners and home sellers in the upcoming market, and of course, the changing market. So let's dig deep into this topic, the housing market forecast. Of course, what I'm going to say, I'm going to give you my opinions, but I'm also going to share with you some reports from real estate experts, from some surveys done, and also from some reports that we want to share. So what's confusing about this housing market crash? The confusing thing is the first thing we have to realize is there's so many reports since the last 3 months, since the last 6 months, since the last what we call last year and the last 2 or 3 years. We have been hearing from experts and real estate gurus and the economist and the analyst in real estate that there is a housing market crash coming. We've been hearing that since 2021. At least I'm hearing that since 2021, but we haven't seen it yet. It's half of 2024. And as far as I'm concerned, I don't see a sign of a housing market crash based on the numbers, and we'll talk about the numbers shortly. So given that, there's a lot of confusion out there. Yes, inflation is high. Yes, the home prices are very high. Yes, the interest rates are at almost today's rate. I checked, a 30-year fixed rate is 6.86%, which is quite high compared to 2-3 years ago. It was at 3%. So, and the affordability is very low. A lot of the buyers who want to buy cannot buy, and they're not buying. So we understand that all this combination has slowed down the market, yet it does not point to a crash. So let's look at some numbers. I mentioned earlier there's a lot of misinformation on this topic. So let's talk about that. I want to show you something here. Let me get to the slides quickly here. Talk about misinformation. Here's what's out in the media, and there's reasons why media, and when I say media, I'm talking about the TVs, the news stations. Now there's a lot of influencers out there. There are a lot of YouTubers out there. So there's a lot of misinformation depending on who you hear and what they are trying to say. And also the other thing is what they say and what you hear may be different. So the misinformation is the US headed towards a recession despite cooling inflation? Home prices are soaring. Is this another bubble? And these are all recent articles in the newspaper or on TV or magazines. From real estate, is the housing market going to crash? What the experts are saying. When will the housing market crash? Will the housing market crash in 2024? That was updated from June 2024. And then the other headlines are the economy might be booming, but housing is in a recession. Top real estate CEO says he's never seen anything like this in its 20 years. Okay. Sorry about that. Okay. Okay, can you see me now? Okay, sorry about that. So let's move on. Talking about misinformation, a few months ago, one of my good friends saw a YouTube video and he sent it to me and said he's been following this gentleman that I'm going to talk about. And he's been talking about a housing crash in 2021. And then another friend of mine sent me the same video. So that got me thinking when I was preparing for this live stream and talking about and researching about the housing market update. I came across his channel. I went to his channel. His channel, you might have seen it. His name is Graham Stephen. He has almost 4.75 million subscribers as of this morning. And he has been saying, and I printed it out to show you what the topics were. 2 years ago, he mentioned that the housing market is sinking on his views. He had almost 353,000 views on it. About 4 months ago, he said that when the housing market crash will happen. That was just 4 months ago. But 6 months ago, he had a big headline on his thumbnail saying it's over. How the housing market crash will happen. So a lot of misinformation. In fact, 11 months ago, he said that the housing market is getting destroyed. Well, I got news for you. There was no housing market. So how can it be destroyed? And I'm not trying to criticize this YouTuber. I'm just saying this was something that came personal to me from two of my friends and clients, and they were confused watching this article. Here's another one. He said 1 year ago, actually just 24 months ago, he said that when the housing market crash will happen. This was in 2024. Now, just 2 months ago, there was a title on his YouTube channel saying, Housing Expert, Why Home Prices Will Crash in 2026. Wait a minute, 2026? You were saying it's going to crash in 2021, 2 years ago, in 6 months, in 11 months. Now he's saying it's crashing in 2026. So that's the type of misinformation that I'm talking about. There's a lot of misinformation. So you don't know what's true and what's not. And you don't know who to believe. We will know when there is a recession or there is a housing market crash when it arrives, because you won't know. In 2008, I was in real estate and all the realtors kept wondering what's happening. There's no sales. Nobody's buying. People cannot afford these homes. People were in escrow and the escrows fell out because they lost their jobs. So we were really puzzled. We didn't know what was happening. We kept spending, at least I did. I kept spending more money marketing, spending more money. And so my business go from here to here in 2 years. Pretty much I made 1/3 of what I made 2 years ago during the recession. So we won't know there's a housing crash until we're in it. It's like you won't know the temperature of the water until you get into the water. There's no way to predict it and feel it. So it's kind of hard to predict what's going to happen. So what is a recession? Talking about recession, let's see and define what recession is. I'm going to use a slide here if I can. A recession is a significant, widespread, and prolonged downturn in economic activity. A common rule of thumb is that 2 consecutive quarters of negative gross domestic product, GDP, growth indicates a recession. However, more complex formulas are also used to determine recessions. So as you can see, we are not in a recession right now. If you look at further charts, in 2020, Q2 and Q3 of 2020, we did have a recession. Of course, I'm sure COVID has something to do with it. And if you look at the last 7 quarters, all quarters in a row, we had a growth in the GDP, the gross domestic products. Also, starting 2021 through 2022, there were 6 quarters where we had growth in GDP. So we are not seeing any recession signs right now. We have had 6 quarters in a row as of 2024. The last 6 quarters, we've had an increase in GDP. So I'm not sure if you're going to get a recession or not. So let's see what's happening. As of right now, the GDP is actually growing. So that's why there's a lot of confusion. The other factor we have to look at is how many consumers, and when I say consumers, in this case, it's home buyers, home sellers, property sellers, income property investors, income property sellers, or even when you look at commercial properties, people who want to buy, or institutions who wants to buy or sell. What is the perception of what's happening on the market? Because the numbers can say as much as we want. Numbers will tell everything. But until we know how the buyer feels or how the seller feels, we won't know how they react. Will they buy? Will they sell? Are they holding? How long will they wait? Because of the fears of a recession, fears of a housing market crash. There was a survey done by Harris Poll, It said nearly 3 in 5 Americans wrongly believe the US is in an economic recession. Think the US is experiencing a recession. So out of the survey, 56% of all those consumers surveyed by the Harris poll, 56% thought that we are experiencing a recession, despite the fact that in the last 6-7 quarters, there was an increase in the gross domestic products. Further, it says that 55% of those polled believe the economy is shrinking. Now, we just saw the chart, or I just talked about the GDP going up 6 times in the last 6 quarters. So the GDP is actually growing at a slow pace, yet it is growing. But the consumers feel that it is shrinking and the economy is slowing, or we are experiencing a recession. So, what the facts are there, and how we feel and how we react and how we take actions, whether it comes to buying or selling or refinancing or holding off, is two different stories. Because I may have money, I may be qualified, I may have a lot of down payment, I may know where I want to move. But if I feel that there's a housing crash coming, if I feel that the housing market will crash, if the prices will drop 20-30%, I as a consumer don't want to buy. So it's a very tough situation. It's a dilemma that let's see what kind of impact it has on the next few months, the rest of the year, as far as the number of home sales, what's happening to the home prices, are the interest rates going to drop, is the election coming up, is it going to have any impact on the housing market or not, or even on the economy. So let's see what happens. And also, I wanted to take a quick moment and thank you for watching my channel and my live stream. If you have any comments, or if you want to share with us what you feel, and of course, what's happening in Orange County, I'm in Anaheim Hills, California, what may be happening in your area, whether you're in Texas or in Florida, or you're in Seattle or Idaho, the housing market is totally different. The economy is totally different. So make comments, whether you're watching live or you're watching a recording. Like to hear and find out and share with other viewers what's happening in your local market, or what you feel about the housing market personally, or based on your experience on reading articles or watching YouTube channels or listening to influencers, and see what impact it has on yourself or the people you know. So we'd sure like to find out. So also, if you have any questions, comment below. I'll try to answer them, and be glad to chat with you as well. There's another poll done by the Harris poll, which I'm going to read out. It says, what Americans are saying in this data is, economists may say things are getting better, but we're not feeling it where I live. Just what I mentioned, what the facts say and what we feel, what we perceive is two different things. And that's actually happening right now. Personally, myself, I have a lot of buyers who want to buy, but they're saying, what if there's a market crash? What if I buy right now? In Anaheim Hills, for example, the median home price is almost $1.2 million for a single family home, which is very high compared to 3 years ago. It was near $1 million or less than $1 million, and now it's 1.2. So if I had a buyer, or if I'm a buyer, I may feel the same way. What if I buy and the market crashes and my home value drops 20%, 30%? So I'm buying it at 1.2 and now it's only worth $1 million. What if I lose a job after 6 months? I may not be able to sell. So there is that fear from a lot of buyers that I've talked to personally, and also talking to other realtors in my office. We have over 120 realtors in our office, and we chat every Tuesday. We have a meeting and we chat about things, what's happening, what are the buyers thinking, what are the sellers thinking, are they holding off selling, are they holding off buying, are they waiting for the interest rate to drop, on and on and on. So there's a lot of misinformation out there, a lot of true data out there, but you just don't know what to believe and you just don't know what to do. And of course, this data is national data. What applies to Orange County, California, this data may be true, but that data may not be true, let's say in Austin or in Florida. As you may know, right now, Florida is in what we say a crisis mode. There is a lot of inventory in Florida because of the insurance crisis and the homeowners association crisis due to that building that crashed a year ago with the water damage. It crashed, so the HOAs are very strict. There's a lot of floods in California. There's a lot of wildfires going on and a lot of other disasters going on in all over the states. So the insurance rates have really not just gone up, it has skyrocketed. So there's a lot of factors influencing the purchase of homes, the sale of homes, not only the price, but other things, cost of goods, cost of property tax going up, cost of insurance going up, cost of gas going up, cost of Big Mac going up. You must have heard about the Big Mac that was sold. I'm not sure what state. It sold for $18, and they were all over the media, all over the social media, all over the news. That tells you where the prices are. $18 for a Big Mac. Wow, that's pretty expensive. Talk about home prices high. Talk about burgers that are high. Even now, there's a Carl's Jr. near my office, and when I drive by, I see specials for $14.99, $15.99 for a Coke, fries, and a burger, $15. I don't think that's a special, but that tells you where the economy is right now and where the fear is with all the people there. So why are our perceptions so distorted? To be fair, and this is from the Washington Post, to be fair, some economic jargon means specific things to economists, but it is used differently by normal people. So what does that mean? Well, for example, to economists, recession means that the economy overall, as measured by the output, employment, etc., is shrinking. But lay people often use the term more loosely to mean something feels bad about this economy, such as high gas prices, and as I mentioned, such as Big Macs and other burgers. This difference in usage might account for why a plurality or a majority of respondents in that Harris Guardian poll believe we're in a recession now, while almost no professional economic forecast agree that. So there is a disconnect between reality and what they are doing right now, and that does affect the housing market and the economy. Like I mentioned earlier, if you have any comments or if you have any questions, please post those and I'll try to answer those as much as I can. We'll kind of move on. Also, if you can comment below, as I mentioned earlier, what area you're in, what's happening in there, not only with the home prices and the buyer activity, but what's happening to the general consumer confidence. Are they buying more stuff? Are they buying less stuff? Are they conserving? So whatever is happening that affects the housing market or the real estate market, we'd like to know. So if you can comment, it'll be really appreciated. I'm going to talk about another survey that was done. This was from the Washington Post. In reality, the US economy has been growing consistently for 2 years, even after accounting for inflation. And as we know, the inflation was quite high. It was almost at 7-8%. It has come down significantly, but it took its time, and the inflation had a toll on the housing market and other economy. By virtually every benchmark, in fact, we're exceeding growth expectations. The US economy has been outperforming other advanced economies. We're also doing better than pre-pandemic forecast had situated us by now, both in terms of gross domestic product and the number of jobs out there. So we just continue about this misinformation, the different numbers out there and things like that. So I wanted to take a pause and not talk about any more polls or how we feel. I wanted to talk about, is the housing market at risk of a crash based on what's actually happening and comparing that to what happened in 2008. As we know, in 2008, we had it was actually surprising that it happened. Prior to 2008, if we go back in 2004, 2005, 2006, homes were selling like hotcakes. There was a joke out there that if you had a driver's license, you would get a loan. Lenders, I would say, let me rephrase that. Greedy lenders were giving loan to everybody and anybody. For example, there were so many toxic loans out there. They were giving loans, adjustable rates. I'll give you an example. What led to the recession? Well, one of the reasons that led to the recession, there was a lot of reasons, but one of the main reasons, and that's the perception, and that's also my perception. I'm a consumer at the end of the day, and that was my perception. And based on reading a lot of reports, going through the whole transactions in 2007, 8, 9 in the recession, the root cause or the fire that got us to this recession were toxic loans. And what is a toxic loan? One of the types of loans I'll give you, and I've actually sold those to a buyer. I was a listing agent and a buyer brought in a loan. There were three brothers buying the house. They were probably making minimum wage, but the loan was what we call a 1-in-3 ARM loan, and the rates were 2%. So what happens is the first year the rate is 2%. The second year it goes up by a percentage, which is 3%. The third year it goes up by another 0.5% or another percent to 4%. And then after 3 years, if it's a 1-in-3 or 1-in-5 or 1-in-7, that means it adjusts after 7 years, or it adjusts after 5 years, or 5 years, or it adjusts after 3 years. What happens is after that adjust period, it goes to what the current rate is. So if the current interest rate was 6%, then your rate would jump from 3% to 6%. So that's one thing that led to people not affording the homes, because if their payment was at 3%, let's say at $2,000 a month, and now it jumped to 6%, the payment probably ran up to $2,800, $2,900. And at the same time, the jobs were at risk. So the home buyer could not afford their home after 3 years. So he or she let go of that house because they could not make the payments. That's one bad thing. But going back to the 1-in-3 loan, the way these first-time home buyers qualified, as I mentioned, there were three brothers and making barely minimum wage, if I can remember. This was back in 2008 or so. What the lender did, lenders were very smart. What did they qualify for the loan? Here's the kicker. They qualified for the loan at a 1% interest rate. So even though the rate was only 1% for the first year, the lenders qualified the buyers at 1%. So they could afford it. The payment was $1,500 and they were making minimum wage. So based on three brothers, and I'm assuming they had wives or spouses or kids working together, they could afford this home. But the second year, that $1,500 jumped to $2,000. The third year, it jumped to $2,500 a month. And the third year, it jumped to, let's say, $3,000 or $2,500 or $2,700 a month, as an example. And that's what caused a lot of people just letting go of their homes. They just walked out on it. They could not afford it. And that's just one example of a toxic loan. And that's part of the reason that the recession came into play, because people not only could not afford the loans at one point, but if they were laid off, no companies were hiring because economy was down. There was a recession, income was down, nobody was buying anything. So if you lost a job, I had 2 escrows in the same week cancel because we barely got the buyer loan. We were ready to close. And a week before close, both these buyers, 2 separate buyers on 2 separate homes, they both got layoffs and they both got laid off. So we had to cancel the loan. They lost their appraisal money. They lost the inspection money. They did get their deposit back, but that was a loss to the buyers. We did so much work as agents. We worked and worked and worked. We got the appraisal through, because at that time, appraisals were not going through because every month the prices were going down. So it was very hard to sell a home, number one. Then number two, it was very difficult to have it appraised because we had an issue with appraisals. And then it was very hard to close because anything could happen, and anything did happen. One of the things that happened on a house, I did not sell it, but one of the agents in our office sold a house. It was at that time $1.3 million house, which was a luxury home in Yorba Linda. And it was a custom home. It was a short sale for 2 years. The owner did not want to let go of the house. So it was a short sale and kept on extending his stay or her stay in there. Finally, they sold it. And then the buyers moved in. Guess what the buyers found out on day one when they moved in, when they turned on the waters, when they took the showers? Everything flooded. And why did it flood? Because the seller who sold the home was so mad at the system, at the housing system, at the lenders, at the economy, that he poured concrete into the plumbing system and clogged everything. So it cost this new buyer thousands and thousands of dollars to repair that. So that's what happened in the economy. But going back to the housing crash, what is a housing market crash for us to understand? In general, a housing market crash is defined by a rapid decline in values leading to a peak to trough fall of 20% or more, which is what happened in the aftermath of the financial crisis of 2007 and 2008. So I wanted to show you this scenario is not likely right now. When we say, I personally don't believe there is going to be a housing crash, because right now homes are selling. In fact, they're selling at a rapid pace. They're selling within, at least in Orange County, a well-priced home in good, relatively good condition in a relatively good neighborhood is selling right away within 10 days or within 30 days. Nationally, from what I'm hearing, is on average homes are selling within 30 days. Of course, 2 years ago they were selling within 10 days. Some homes sold within hours. There was a line of 100 people or 100 buyers coming to an open house. Those days are gone. But even in this market, with the higher interest rate, even with the higher home prices, there are still buyers buying homes even at this price, and they're buying right away. They're buying within 1 week, 2 weeks, 3 weeks of the listing price. So what is very unlikely is that today, and this is from the US News, today the combination of this lock-in mortgage effect for homeowners, more millennials purchasing homes, and population growth returning to pre-pandemic norms will continue to add to the pent-up housing deficit, which was recently estimated to be 4 million units by Bank of America, the analyst at Bank of America. As long as demand exceeds supply to this extent, a housing crash is unlikely, absent economic shocks, including surges in employment, delinquencies, and foreclosures. So, as I mentioned earlier, we do not have a lot of inventory right now. And I can show you a slide if I may. Let me see if I have it ready or not. Not that one. Sorry about that. Well, actually, I don't, but this is not the one. Let me remove that. But anyway, I wanted to point out to you about the 2008 inventory compared to the inventory right now. As of right now in 2024, the last few quarters, we are averaging nationwide. The inventory is about 3.4 months. What does that mean then? Inventory, when it comes to housing market, is if no other homes come on the market today, and let's say today we have an inventory of 3.4 months, and if no homes come on the market, it means that it'll take 3.4 months or 3.4 months to sell all the homes on the market today. So if there's a million homes for sale today, in 3 months they'll all be sold. But if you look back at 2008, 2007, 2008, in 2007 there was almost 9 months supply of homes for sale. In 2008 there was 10.4 months of homes for sale. That means the inventory was 10.4 months. Now, when there is 10.4 months of supply, what happens to home prices? Well, the law of supply and demand. The higher the inventory, the lower the price, and lower the inventory, the higher the price. So if we compare the prices in 2008, the supply was 10.4, and if I remember right, I saw a report, the median home price at that time during this high inventory, the home prices were around 165,000 to 175,000. Currently in 2024, the inventory is about 3.4 months. And if you look at the medium sales price in USA, it's around $420,000. So there's a stark difference in prices. It jumped from $165,000 in 2008 to almost $400,000. And the thing is that they're selling like hotcakes even now. Homes are selling. So moving on, there's simply just not enough supply. And when the supply is low, the prices stay stable. So the economics of supply and demand, if there's a shortage, prices simply cannot crash. And if you are thinking about why there is no crash, if there's one thing why there will be no crash is because there is not enough inventory. And until there is low inventory, and until there's more homes coming on the market, and until that inventory jumps, and the inventory is not jumping, it has gone up slightly from a few months ago. It was 3.2. It's about 3.7 right now nationwide, which is not a significant jump. But that is a low inventory and homes are still selling. So the main reason why there is may not be a crash is because homes are selling briskly and the inventory is low. But let's talk about equity. Equity is a thing that all the homeowners have. Anybody who bought in the last 2 years, prices have gone up 10 to 20%, depending on where they are in the last 3-4 years. If you look at the last 10 years, prices have been going up since 2011, up and up and up and up. And then there was a significant jump in 2020, 2021, 2022. So if I had to guess, 10 years ago, if there was a house for sale, I would guess home prices have doubled in value. What that means is there's a lot of equity in all the homes. So when do people let go of their home? When they don't want to pay the home, when they don't want to pay the mortgage, because they feel like, why should I pay a mortgage if the value keeps going down? I can't afford to pay the mortgage, and if I sell the home, I have to put money into the house to close the deal. But today that scenario is reversed. There is so much equity in the homes. I'll give an example. Let's say I'm going to talk about Anaheim Hills. Let's say I bought a house 5 years ago and I had bought that house for $900,000, just as an example. 5 years later, right now, the median home price is 1.2. So let's assume that my house is worth 1.2. In other words, I paid $900,000, and let's assume I put 10% down. So I put, let's say, approximately $100,000 down. So I put 100,000 down, and now my value has gone up by, let's say, 900 to 1.2. So that's $300,000 in equity, up in equity. So my total equity has gone up by $400,000, and I'm not even counting the payments I made. So I have a $400,000 equity sitting as an average, as an example. Let's say I lost my job and my wife lost a job, and we cannot find a job anywhere. It's been a year and I could not find a job, but I will keep making those payments. Or maybe I did not make any payments because I did not have any savings. And there's statistics that an average American does not have enough reserves. Maybe they have 1 or 2 months reserve, but most people don't have any reserves. In fact, there was a statistic, or there was a survey done that on average, if somebody has to come up with $1,000 today as an emergency, more than 50% of all the Americans would not be able to come up with that $1,000. So that's a whole new topic. But what I'm trying to get here is that because of that equity, if I lost my job and let's say I did not make payments for 12 months, and if the banks want to foreclose on it, they cannot foreclose on it, because even if I can sell my house at 1.2, I have not made any payments for 1 year, let's say, as an example, and there is attorney costs and penalties and all that. I can still sell my home at 1.2 because that's the market, and I'll walk out of it. I will still have 200,000, 250,000 in my pocket, despite me losing a job and not finding a job. So because of this equity, even if people lose their jobs and they sell their home, there's not going to be any short sale and there's not going to be any foreclosures, because all these buyers, on average, of course, I'm talking average, have so much equity. So when you combine low shortage of inventory, when you combine the high equity, it does not equal to home prices crashing anytime soon. That's my opinion, and that's what the data is sharing. So I'll go on, but in the meantime, like I mentioned earlier, if there's any comments, any questions, feel free to comment below. And if you're watching this recording, I'd sure love to hear your opinions, what's happening in your area. Another survey was done, or another remark was made by the Business Insider. They're saying that though many Americans believe the housing market is at risk of crashing, the economists who study housing market condition overwhelmingly do not expect a crash in 2024 or beyond. And this is not me saying, this is what the Business Insider is saying. So I'm going to add this slide. So if you look at this slide, this was a survey done by Lending Tree. It's a lending company. And it asked, do you think the housing market is at risk of crashing in 2024? So this is a very recent poll. In fact, it was done in October of 2023. And if you look at it, 44% of the respondents in this poll said, yes, there is a risk of crashing. And if you notice on the right-hand side, the millennials was the highest people who said that there's a high risk of a housing market crash. Gen Zs was 48%, Gen X was 42%, and the baby boomers had 30%. So in this survey, do you think the housing market is at risk of crashing in 2024? 44% said yes. 31% were not sure about what's going to happen. And 25% said no, it's not going to happen. So there is a difference of opinion out there, not only in general, but when you compare the seniors versus the Gen Zs or the millennials, there's a big difference on how they feel about what's happening. But the fact of the matter is, no matter what the statistics says, like I said earlier, there was a less inventory compared to 2008, almost one third. There's high equity compared to 2008. There was zero equity in 2008 because everybody refinanced during 2007, 2006, pulled out money, bought boats, remodeled, took vacation, and when the market crashed, they had zero or negative equity. That is reversed right now. Everybody bought well, put down payment, made the payments, and the market has grown and grown and grown 5%, 5%, 5% over the last 4 or 5 years. So there's a lot of equity. I would say there's 20, 30% growth in equity just in the last 4 or 5 years, let alone those who bought in 2010, 2011. So as you can see, what the survey says and what people are feeling is two different things. Going back to the inventory, I wanted to mention to you the exact inventory stats. In January of 2024, there was 3 months of supply of homes for sale. This is nationwide. In February, there was 2.9 months of supply. In March, there was 3.2 months of supply. In April of 2024, it was 3.5. And I mentioned earlier, there is an uptick in inventory. So in May, the inventory went up to 3.7. Hopefully, it may go to 4. We don't know. We'll find out. We don't have the data out yet. But if you look at the average from 1999 to 2023, the average months of supply was 5.3 months. Remember, we had the 2008 inventory up there, which was 8 months. So I would say the average was more than or less than 5.3 months. And right now, we're at 3.7. So even if you look at the average at 5.5, we're at 3.7. We may be holding there. We may get to 4 months by December, who knows. So as long as the inventory is remaining low, as long as equity is still keep increasing, because from the report that I've seen, from the activity we've seen, multiple offers out there, homes today, July 2024, there are still homes having multiple offers, and there are still homes selling over list price. Maybe not by much, maybe by 10,000, 15,000, 5,000, 50,000 in Orange County, 50,000 or more. There is still a rise in home prices. That means there is still a rise in equity. So until those numbers come down, there is no sign of home prices crashing. Maybe a price drops, but definitely not a crash. There was another survey done by Lending Tree again. Do you think the housing market is at risk of crashing in 2024? And again, 44% said no, 25% said no, and 31% they were not sure. So there was a survey done by Zillow. And Zillow, as you know, is not a housing company, but it's a data mining company. And a lot of people visit the Zillow site. So I thought I'll use stats from Zillow because a lot of people watching, a lot of people buying and selling are familiar with Zillow. So Zillow said that in 2024, they expect that they'll see a home appreciation take a step back, but not plummet. So what they're saying is that, yes, the home appreciation will slow down, but there's no way it's going to plummet in prices. Again, they get this information from all the data they have nationwide. And of course, local markets may differ. Real estate is local. So all these are stats, may not apply to you. And that's why I keep saying that, hey, in your local area, let us know what's happening in your area. I mentioned earlier that Florida has a big jump in inventory of homes for sale because of the disaster and high insurance rate, because of the skyrocketing homeowners association, because a lot of people from, if we Californians cannot sell homes, or the people in New York cannot sell homes, and a lot of people who went to Florida and all those areas, then it's a slowdown for them. So there's definitely a slowdown in housing sales. There's definitely increase in inventory in cities like Austin and Florida and other states, Texas, for example. So we'll see how that affects those areas. And another survey was done. Let me see if I can share a slide with you. If I have it up, let's see here. I'll share it with you. It talks about, this report is from Case Shiller, and it talks about home prices are moderating. We talked earlier, Zillow saying that the home prices are not going to plummet, but Case Shiller is saying that year over year, the changing home prices, there is still an uptick in home prices. In January 2022, there was a 20% change year over year for the last few years. And in January 2024, there was a 5% change in home prices from a year ago. And in 2024, April, there's still a 5% change year over year on home prices moderating. So we don't see any decrease in home prices, and this is on a national basis. So prices are not spiking, but they are still going up slightly, maybe 1 or 2%. But again, it all depends on your local markets and your local areas. So let's see what happens as we go along. Let's see what happens to the home prices. Again, I mentioned earlier, we are expecting a change in home prices, actually on home interest rates. And a lot of the people who cannot afford to buy homes right now because of the 7.5% or 8% or 6% interest rate based on your credit score and your debt ratios and all that, what they are saying is that when the rates go down, and there's a big hope that by September, they've been saying over and over again that there's a price drop going to happen in September. Let's hope for the buyer's sake that they do drop. So a lot of the people who cannot afford homes right now because of the high debt ratios, because of the high interest rate, they are able to buy a house when the rates drop. But the expectation is, or what the inclination is, that if the interest rates drop, and that brings a flood of home buyers that were waiting for the interest rates to drop so they can buy the home, what we expect to see is, we expect to see multiple offers, because a lot of the buyers are jumping in to buy that home now that they can afford it. So when you have multiple offers, the prices are going to start ticking up, and that will lead to a price increase. So it's great to see a interest rate price drop, but it only means that following that price drop, maybe after 2 months, 3 months, 6 months, the indication is, or the inclination is, that the prices will go up as well, because all the people who could not buy are now buying, flooding in to buy, expecting the rates to go up. So when they drop, they're going to jump in to buy, and that'll create a price increase. So that's where we are right now. There's too many factors, too many scenarios. There's no one concrete thing to say what's going to happen to the prices. Are the rates going to go down? When they go down, is it going to affect the home prices? When they go down, are the buyers going to jump in and buy, or they're going to still hold and say, well, it was 6.8 in July and now it's at 6.5 or 6.4. Maybe I should wait till December where it's 6% and then buy. So we don't know what's going to happen. We don't know how they're going to react. We will just have to wait and see. Real estate is based on data, and real estate is based on what consumers do at any given time. We can only expect to see what they're going to do or what they are not going to do. Of course, we will have to see. According to Forbes, as already high home prices continue trending upward, you may be concerned that we're in a bubble ready to pop. However, the likelihood of a housing market crash, a rapid drop in unsustainably high home prices due to waning demand, remains low for 2024. This is Forbes talking, saying that there's a likelihood of a market crash is not there. So that remains to be seen. I wanted to dive deep into this and give you some numbers. As I mentioned earlier, what happened in 2008 was a disaster. It took to get there from 2004, 2005, 2006, when people refinanced and took out all the equity. So the house value reached a peak. All the lenders kept on refinancing with easy terms, and all the buyers who could not really afford a home kept buying, and that led to a crash. Of course, there was other economic factors that affected that. But this scenario, as I see it, is completely different. All the buyers who bought in the last 3 or 4 years, in the last 4 or 5 years, in the last 10 years, the lenders were very, very, very strict because they learned their lesson from the recession and the crash of 2008. So the way I see it, all the loans given in the last 10 to 12 years were given to A buyers. They checked the credit very thoroughly. They checked their credit scores very thoroughly. They checked their stats and the debt ratios very thoroughly. So the homeowners are very strong. They had stable jobs. They had enough money. They put a lot of down payments. And to make things even better, in 2022 or 2021, when the rates went down to significant low rates of 2%, 2.5%, I've sold many homes myself at 2.5%. A lot of people, more than 60, 70% of all the homeowners who had loans refinanced. And there's a lot of people. In fact, the stats say that of all the people who refinanced, and from those people who refinanced, more than 50% refinanced their loans under 4%. So what happened was their mortgage payments dropped from, let's say, $3,000 to $2,500 a month. So we have a lot of homeowners sitting with low interest rate, low payments. So even if they lose their jobs or the economy slows down, my gut feeling is they will be able to make their payments. They were very strong buyers. They refinance. They have a lot of equity. So the path to housing crash is very slow and very gradual. So let's see what happens. One of the impacts that I want to talk about, in fact, if you're still watching this, next week I'm going to talk about the National Association of Realtors, the settlement that they did because of the commissions. As you may know, the sellers can no longer pay the buyer's agent any commission. So the new rule or the new regulation is the buyers have to pay the buyer's agents. And I did a video a couple of weeks ago, and the talk in the town is, or response from the video is, a lot of the buyers are not going to pay commissions to the buyer's agent. They can't afford it. So how much of an impact is that going to have moving on with this whole new commission structure? For the last 100 years, on average, sellers have been paying 5%, 6%, 4%, 7% commissions to the brokerages. And usually what happened with that commission, if it was 6%, for example, the seller's agent took typically 3%, and the buyer's agent typically took 3%. So it was split 50-50. Now with the new regulation, seller cannot pay the buyer's agent at all. No commission allowed, period. They may be allowed concessions, but not commissions. And the concessions can only be paid to the buyers and not the buyer's agent. So the buyer's agent has to get the money or the commissions or the concession from the buyers. How much impact will that have on this housing market? It's new territory. Hasn't happened in 100 years. A lot of the realtors, including myself, not nervous, but anxious to see what the buyers are going to say, how the sellers are going to pay. Are the sellers going to pay concession to the buyers? And if the buyers can give that concession to us, is that going to happen or not going to happen? So I'm going to talk about that, deep dive into that, and also talk about at that time next week how much impact it'll have on the economy moving forward. And when I say economy, it's about the housing economy, the housing trend, because this is a total new arena, total new chapter we're going on into. So I'm hoping that the information I've shared will give you some insight, and based on these stats, you can make your own decision or make your own conclusion on where the housing market is going to go. And of course, I've mentioned it many times, your area may be different than mine area. I see in Orange County home prices still going up, not only rest of 2024, but the rest of 2025. I personally see, based on the activity, based on talking to other agents, based on talking to a lot of investors, there's a lot of money out there. There's a lot of 1031 exchanges happening. There's a lot of inheritance money coming in. I've sold 2 homes in the last 4 months where both the single ladies bought homes, $800,000 each, different condos they bought, and they put $250,000 each. They were friends. They both had parents, gave them $250,000 to buy a house, and that's inheritance money. They could not have afforded it, so they put 250 down. Of course, some was their own savings, some was from their parents. So there's a lot of inheritance money coming into the housing market. So all this, at least in Orange County, I feel that home prices will be stable, maybe go up slightly, maybe by 1 or 2% or 3%. Let's see what happens, but I don't see them coming down. Of course, that is my opinion only, but nationwide, by talking to a lot of realtors, by reading a lot of reports, by watching videos of YouTubers, and I watch videos of YouTubers who don't lie things. They don't say things because they want media, they want traffic, they want to earn your commissions from advertising. I watch reliable YouTubers, and they're all saying that they don't see a crash coming, but they see a stability in home sales and home prices, but they don't see a crash coming, at least until 2024. So it remains to be seen what's going to happen in 2025. And I want to ask you a question. Does the election impact housing? What's your opinion? Give us some opinions. Have you seen in the last 4 years and the 4 years before that, did it take the housing market up or down? What's your opinion on it? Because a lot of people ask me that question and I say, I have no idea. So I tell them I have no idea. So if you have some ideas, share with us or comment below. I personally think it won't have much impact on it. But again, that's just my opinion. So thank you for watching. I hope you come back same time next week, Monday at 4:30, and I'll talk about the NAR commission settlement. Thanks again for watching.